Hello and welcome to Weekend Investing Daily Bytes. We're shooting episode 221, 4th of May, and there was a sudden and unexpected RBI move to raise the policy rate by 0.4%. The Fed move is expected tonight to raise by 0.5%, and it seems that RBI was keen to front run that decision and hike at their own end. This was totally unexpected. There was no meeting scheduled. The next meeting, I think, was scheduled in June. So it has taken the market by surprise, and most stocks were reeling after this announcement today. In general, as interest rates go up, markets find it challenging to keep up with the pace of borrowing and investing, and the cost of money for every company keeps increasing. While for a limited period of time, the increase in interest rates doesn't hurt much, but if this inflation animal does not get controlled by uh, by the increase in rates, then of course the impact on the markets is also quite severe. But today market was totally taken by surprise, and I think that's why a lot of positions got cut, and it was essentially a bloodbath everywhere. As you can see, all sectors except public sector enterprise uh, just got smashed between 1 and 3%. Those that had gone up more recently got bashed up more, and there was really no place to hide as such, barring some few odd stocks which were running based on some news or some results, etc. In terms of the overall indices, you can see that all the indices were down more than 2%, and Nifty Next 50 was the worst hit at minus 2.88%, but all between 2 and 3%. And the weekend investing small cases also were hit pretty badly, between 1% and 3.3%, in line with more or less the broader indices. So tough days. Nifty was sort of wiggling around the 200 DMA for a long time, and today it has given sort of a decisive move down. We also have to face tonight's action, where Fed is expected to raise 0.5%. If there is more hawkishness or a higher cut than that, then of course we'll see more downside tomorrow. But as of now, the sentiment is pretty weak, and it's time to not sort of go beyond your uh, planned moves, as in escape or gradual entries. If you are doing, there is not a time to catch the falling knife, so as to say. In terms of the top gainers, we have Future Consumer, which has bounced from its lows at plus 8%, Rain Industries plus 5% on its results, ONGC up 4%, oil is continuously gaining now, again near 109 Brent oil. So oil, which was deemed to have gone off the rails, and was looking at going below 100, did not do so, and has come back. Britannia up 3.5%, Gujarat Ambuja Exports up 3%. In terms of the losers, big losers were Varroc Engineering minus 20%, Vardhman Textile, a very reputed name, minus 11%, Network 18, TV 18, both down 9%. They've been dropping since that announcement of the reorganization and merger of Viacom, and Spandana also down 9%. So why all this panic is happening is also because the world is seeing it is sort of a trend change, or at least it looks like that as of now, in terms of interest rates. For the last 35 years we have been in a falling channel, and now for the first time it seems that that falling interest rate channel is getting broken, and higher interest rates will be needed to curb in the enormous inflation that global economies are witnessing. At most places, inflation is at a 20-30 year high, in places like US and Europe, which have very poor savings rate, and not just poor savings rate, but very poor returns on savings in the CDs or fixed deposits as they have it. The pensioners there will have a very tough time, who have no exposure to risk. So essentially, what the market is doing is pushing everybody to take risk, and that too, when the markets are falling. So it's become quite a murky situation in terms of what to do and what not to do. Also, Nifty was playing around this 200 DMA for last many sessions, and today, as I said, it has broken down. So maybe in worst case scenario, we may see this 15600 level, consolidation level, comes again. But in case not, then at least wait for this 17400 level to get broken before building or catching any more positions here, because this is currently looking reasonably weak. The insight that we wanted to share with you, and it was shared I think a day or two before, was that many popular names have not given the kind of results that one would expect from them. So don't invest in stocks just because those names are popular. And the example here is General Electric Company, which made a high of 440 in year 2000, and 22 years later we are still at $77 on this chart. And as early as 2011, it was deemed to be one of the most profitable companies in the US markets, and it's gone nowhere basically. But the popularity of the name would have caused a lot of folks to keep buying this stock. Citigroup is another classic example, which never could recover after the 2008 crash from 550 odd dollars to about $1, and then of course it has come back to $50. But anybody who would have bought in this entire decade here is still much underwater without having bought more here maybe. And essentially a very large bank, prestigious bank, popular name, but shareholders have been battered like nobody's business. Intel Corp is another such big name which had a huge rally in this decade, leading to the dot-com boom, almost a 480 or 500 times kind of a move here, and then it collapsed equally sharply in the next few years, and it has not been able to pick those heights again ever in the last 22 years. So had you come in during this period, you would not have seen any gains in the last 22 years, but of course if you had picked the bottoms here, you would be in some gain. But what I'm trying to get at is that don't just look at the popularity or the the market share of a company. That itself need not translate into a high returns for you in the long term. So this is a small daily bite today. Thank you so much for watching, and I wish you all the best, and I wish the markets will take a turn and give us more on the greener side than the red side. Thank you. Bye.